Hello, and thank you for viewing the Pacific Business Brokers video educational blog series. One of my very first video blogs highlighted the fact that being an entrepreneur does not necessarily make for being a good business person. Being a business person really means that the entrepreneur or business owner has a greater skill and focus not just on the technical aspect of the operation but also on the business aspect of the operation, and that would include tax planning. Obviously, tax planning, I say, is the alpha and the omega, since it needs consideration at the beginning and at the end and all along in between, and equally as critical to consider both from the perspective of the seller of the business as well as from that of the buyer of a business. Quite often, a deal structure that favors a buyer from the tax perspective can be detrimental to the seller's tax situation, and vice versa. So tax planning is equally critical to the seller as it is to the buyer. By a simple and common example, in allocating the purchase price in an asset sale, the buyer's preferred structure is the fastest write-off possible. From a tax standpoint, the buyer would perhaps want to allocate as much of the transaction value of the asset sale to a consulting contract, perhaps with the seller, the capital assets with the shortest depreciation period, and with the lowest amount perhaps allocated to the goodwill. A consulting contract, however, though an immediate write-off to the buyer, is taxed to the seller as earned income, and generally the highest possible tax rate. So it's good for the buyer, but not good for the seller. The difference between the depreciated tax basis of equipment and the amount of the purchase price allocated is taxed to the seller as a tax recapture, and hence again, not good for the seller, while good for the buyer. In that same transaction example, the seller would likely favor to have more of the purchase price allocated to the goodwill, nothing to the consulting agreement, and depreciated net book value or less to the capital equipment in order to be taxed at a more favorable capital gains rate. Well, such would leave the buyer with a very unfavorable tax position, especially here in Canada, where limited depreciation of goodwill applies. Similarly, there are many other factors to consider when preparing a business for sale or preparing the purchase of one, such as consideration as to whether the transaction will be an asset or a share sale. This is something that should be assessed early on, since this could have a substantial impact or none at all, or somewhere in between. The eligibility of the vendor's capital gains exemption, the eligibility of the business or corporation under the capital gains exemption allowance, how long has the company been incorporated, who the shareholders are, whether the corporation selling or buying is a Canadian-controlled private corporation or a foreign one, tangible and intangible asset transfer portions, personal and corporate tax positions, trust freezes and estates, roll-ups, mergers, gifting, removal of assets such as real estate that are not being sold or purchased with the business. All of these things can have a substantial impact on one's tax strategy and truly need consideration. As you can see, tax strategies need not only be considered by the seller but also by the purchaser, and planning ahead, often as much as 2 or more years, can make a substantial impact if you're the seller on how much money you get to keep and how much you'll end up giving to the taxman. Tax laws and structures are very complex these days. It is highly advisable that a professional tax expert, whether it be a tax lawyer for structuring purposes or a tax accountant for assessing, or both, be engaged to assess and implement the best structure for your sale or purchase, but with a clear understanding and knowledge that it is likely not going to work if it is 100% to your benefit only. If you're the seller and you want the structure to be only good for you, then you likely will never sell your business. If you're the buyer looking to purchase a business with terms and conditions and a structure that will only benefit you as the buyer, you will likely never buy a business. Knowledge and understanding of taxable implications and issues is key. Understanding the opposite side's taxable issues and implications is equally key in order to come to an equitable transaction that both sides are comfortable with. Planning for such events is essential to maximize your tax strategy. Join us again next time to learn more about the many moving parts in the sale and purchase of privately owned businesses. Key knowledge and information to help you achieve your entrepreneurial goals and aspirations.